Yes. In California, there's still a very new type of entity. I believe in 1994, California adopted what's called the Beverly-Kalia Act. And what the limited liability company does, it's a very unique structure, and it allows, in essence, the flexibility of a partnership, which I will get into with LLCs, but it provides the limited liability protection of a corporation. So the corporation has this liability shield, if you will, that any liability at the corporate level will not come up into the shareholder level, if you will. So for example, if there's a debt or obligation or some cause of action that happens at the corporation, with certain exceptions, the shareholders, the individual shareholders' assets, their home, their retirement accounts, their savings accounts, will not be subject to any liability or debt from the corporation. Now the LLC has that same liability structure. What I like about the LLC is when I talked earlier about the formalities of the corporations and the shareholders and the directors and the officers, you have this very formal structure similar to what an HP or Hewlett Packard has to have, and yet maybe you and I would form a corporation, and we would say, we're too busy to run the business to deal with these formalities. So the LLC, what it allows is a flexibility of the two owners, called members under California law, to run the LLC as partners. So you and I assume we're members of this LLC. We do not have to elect directors, and directors don't have to elect their officers, and officers don't have to. You and I can run the business day to day. We can roll up our sleeves as a manager of the LLC. We can call ourselves directors of the LLC if you want. The nomenclature is not that important, but what allows us the flexibility to just get into the corporate, the essence similar to corporate structure with the liability, but run the day-to-day aspect. That has allowed how would I say the change rather has been part of the change for people changing from corporations to LLCs. Now the real kicker is the LLC gives you the protection, like I said, but now doesn't give you that double tax.
Right.
So the LLC's tax, like I'll say, similar to an S corporation. There are a bit of differences. We can talk here in a moment about that. But the partners of an LLC or members, partners from a tax perspective, will get taxed on the income of the partnership, the LLC's tax as a partnership, that flows through to them similar to an S corporation. In other words, you and I have an LLC, we have $100,000 in net income. The LLC will not pay tax from a federal perspective. We'll touch the California law in a minute. But you and I will pick up our pro rata allocation of income on our K-1s similar to an S corporation. Maybe it's probably a good time to talk about the distinctions of California, because I think that does come into play. And that is, in California, S corporations are subject to 1.5% tax on the net income, or $800 of tax, whatever is greater. So there's kind of, I guess, that $800 minimum.
Yes.
An LLC has to pay that $800 minimum tax, but in addition has what we call a gross receipts or gross revenue tax.
Or a fee, actually.
A fee is what they call it. Yeah, they call it a fee to get around. I think that's some tax cases that made them change the name.
Yes. We'll see what happens.
But so at any rate, the fee starts in at about $250,000 of gross revenue.
Yes.
And goes up to, I believe, about $5 million. There's after that the fee stops.
Yeah. So it sort of steps up to different amounts. Yes.
And I believe the fee starts at $900 and finishes up to about $12,000 plus the $800. So there's some planning that's involved. It's not a ton of money, but it's still an opportunity to plan. Now,
but one thing that we have to mention there is that is based on gross receipts. So you could in fact have an LLC that's running a loss and could have to pay a lot more tax than it ever would have had to as an S corporation.
You stole my thunder. That's exactly what I was going to say. That you can add insult to injury, because I have clients that will come in and say, "Oh, it's such a small tax." I said, "But wait a minute." Just like what you said, Michael, that you can add insult to injury if you have a loss. And so there's some planning that's involved. And that's a California distinction, presumably to try and equalize the differences between an S and an LLC. Now let me state one thing about LLCs. It sounds great, let's form one. Not so fast. California has embedded in the Business and Profession Code and the California Corporations Code the types of businesses that are allowed to form an LLC.
Right.
In California, if you come to me and say, oh, I'm a general contractor, I want to form an LLC, you may then have a change of heart because you can't form an LLC in California. In essence, any profession that requires a license, a contractor, an attorney, an engineer, professional engineer, maybe even a cosmetologist because they have a license issued from the Consumer Affairs in Sacramento. So it's very limited. And not that this is really talk about legislative intent, but I believe it was an oversight is what was supposed to be included or not included in the LLCs.
Because there's some controversy about some of that. Like you mentioned, the cosmetologist is, I mean,
right.
The licensure is not, that heavy of a burden, really. It's more of a thing of, public safety and so forth. And so, so there's an issue about whether some of these, and there have actually been some court rulings, as I understand it, that the courts have said, no, we think that these people should be able to be an LLC. But if you don't want to fight, maybe you shouldn't try in the first place.
I believe that there is going to be change coming soon. If there's some talk in Sacramento about opening the scope of what types of entity can be an LLC.
But one thing that I can say is, one thing that LLCs are ideal for, I think, is for investing in real estate. Yeah. Again, we've got these basis adjustment type things that happen for death and so forth. Again, the flexibility of being able to liquidate the LLC without necessarily having a tax.
Right, you don't have that deemed sale necessarily that we talked about earlier.
Right. So anyway, real estate has been particularly attractive and from the very beginning, very, very hot area of LLCs. Yeah. Okay, and we can use these together with other things. So let's talk a little bit about maybe partnerships and limited liability partnerships and limited partnerships.
Sure, the LLPs.
What's all that stuff about?
Sure, so in California we have the Partnership Act, and within the Partnership Act there's the general partnership, a limited partnership, and limited liability partnership. They all sound the same, but there are some differences. They're all taxed as a partnership from a tax perspective, so that at least is nice and consistent. A general partnership can be formed without any filing at the Sacramento level, if you will. You and I can have an agreement to run a business and split profit.
A handshake.
A handshake, exactly. There we go. And we have a partnership. The difficulty with the partnership, from my perspective, is there's no liability protection. So any liability we talked about earlier, at that corporate level, at that partnership level, in a general partnership, will flow through to you or me individually, and that's not good.
So you and I have a CPA firm. I screw up on a tax return. The client sues our rear ends.
And my house is gone.
And you didn't have anything to do with that tax return, but they still can come after you because you're the partner in a partnership.
And that's right. In essence, that is right. We're not protected at the entity level.
Or one of our employees has an accident in a car driving on partnership business. And so if we're underinsured, again, we could have an exposure item there.
That's right. Yeah. So what there is in California is a limited partnership. Now, a limited partnership has to have at least one general partner and numerous limited partners. Limited partners are just what it sounds like. Their liability is limited typically to their at-risk investment, the amount they contributed into the partnership. The difficulty is a general partner still has to be on the hook. So rather than being an individual, sometimes, depending on the situation, you would form a corporation to be the general partner. Getting back to your point, that's why LLCs are a great way to hold real estate, because in the past you would have a limited partnership holding real estate with all these limited partners, and then a general partner maybe as a corporation. You have all these different structures for the limited protection. Just from an LLC, you get the same bang for your buck.
Yeah, or
almost the same.
Yeah, and what some people are doing, again, we were talking about the fee structure. So a limited partnership doesn't have that fee, and so you could have a limited partnership, and then you could have, say, a 5% or 1% LLC as the general partner, and now there's no fee problem.
That's right.
Okay,
yeah.
So So sometimes you can use them in combination like that. You just have to watch the balance for expense and other things, because each of these things you have to have a tax return prepared for each one of them, and so forth. So
right, and that can get out of hand sometimes. Then, but then the last point I was going to make about the LLPs, or limited liability partnerships. That one's an easy one to put in a box. California has a limited liability partnership, really in essence for the professionals that can't form an LLC.
Right.
That's where the disconnect is, we talked about earlier. Now in California, only, if I remember this, they keep adding the types. It's accountants, attorneys, and architects. Where I think they start with the alphabet.
Okay.
ABC. Yeah. And then now they've added engineers and land surveyors.
Okay.
All other types of professions, getting back to your point of the cosmetologist, they're between a rock and a hard spot. They can't form an LLP nor an LLC. An LLP or an LP, limited partnership, has a flexibility of an LLC as far as managing. That's the beauty of the LLP. You don't have to have a general partner. Everyone's protected, similar to an LLC. I will say now, one thing that we could have talked about really in the partnership structure is the beauty of partnerships compared with S corporations is that you can allocate income.
You have special allocations,
different. So if you and I are 50% owners of an S corp, we said we have to have 50% allocation, distributions, and so forth. In a partnership, we don't have to have that. We can slice it and dice it all we want within certain reason. And the tax code has embedded in the regs, actually, the tax regs, a substantial economic effect, which in essence is very complicated, but really in essence what it's saying is the allocations that you and I have in a partnership have to, in essence,
the cash has to follow the
right, has to have economic effect, notwithstanding the tax attributes.
Yes. Yeah.
So it's not as if you take a tax deduction and then later on you don't have to pay the taxes later on. You kind of shift it to me, but that's a whole years of discussion by itself.
Okay. We just have a couple of minutes left, but why don't you just very briefly talk about a sole proprietorship?
Okay, the sole proprietorship is, I believe, the worst type of entity. It's not even an entity to have. All the other types we talked about so far, partnership, corporation, limited liability company, those entities are really separate and apart from the owners. A sole proprietorship is not.
It's the owner.
It is the owner, right. So like a general partnership where you and I talked about we form a partnership, the owner is really running the business as himself. They would have to file a fictitious business name or a DBA with the county where they're operating, but there's no protection whatsoever. I have a client who has several convenience stores, for example, who came to me and we formed some entity protection because we talked about earlier liability. You have a slip and fall, you're really going to have some issues if your insurance doesn't cover it.
Yeah. So the advantage of sole proprietorship really is simplicity. There's not a separate tax return. The information is just reported on your own income tax return on Schedule C. But again, you've got this unlimited liability aspect from that consideration. So most lawyers wouldn't recommend the sole proprietorship type of form.
Right, right.
Folks, we're about out of time here. So it's amazing how the time goes.
When you're having fun, right?
When you're having fun. Carl, I want to thank you so much for being my guest. Carl Heinz.
Thank you.
So Carl Heinz Lashnik, thank you again for being my guest. Hopefully we can do this again sometime, maybe talking about a different subject. And folks, we hope that you've picked up some valuable information. Again, go and get some more advice. But this is a place to start in understanding different choices of form for doing a business. And we'll see you next time on Financial Insider Weekly.